Okay, in this video, I want to talk about two very popular retail trading strategies. They have pretty much the same embedded flaw in them. So I want to explain what that flaw is and how it results in retail traders losing lots of money. So let's look at the strategy number one, support levels. Support levels and resistance levels are a key cornerstone of technical analysis. You'll be taught to use various different aspects in terms of previous highs, previous lows, or those sorts of imaginary lines they call trend lines to create these support levels. Now, what's interesting here is that support levels and resistance levels, you're taught to create them in exactly the same way, using previous highs, lows, and trend lines. And in equity markets, I want to raise the first question mark here, because that kind of similarity in the way you create these levels is suggesting there's a symmetry in markets, in equity markets, that the way that people make decisions, the psychology of equity markets is symmetrical. It's similar when markets go up and when they go down. You create these both resistance and support levels in the same way. Now, I'm going to say to you that that's absolute nonsense. Equity markets are not symmetrical. And I would say all of you, if you think about it, know that. We know that when equity markets fall, for example, fast, the VIX market and volatility shoots up. When equity markets rally, volatility tends to fall. We know that. We know, for example, that over 95% of equity investors only trade from the long side, only from the long side. So that means that their psychology, the way they trade, their fears, their irrationalities will grow on a market fall. When the market falls, they panic. They may end up getting, for example, margin calls, and we know that markets get fast and hard and volatility goes up when equity markets fall. But that's not the case when equity markets rally. Most of the people involved in equity markets are making money when they rally. They're happy, they're fine, they're not getting margin calls, everything's hunky-dory. So we know that the psychology of falling markets is different from the psychology of rising markets for equities. Therefore, using the same types of analysis must be wrong. It must be wrong. So here comes, leading on to this flaw, as a market maker, there's an old saying, there's no support in a falling market. If you're a professional trader and you're looking for exit liquidity in a market that's falling sharply, you want the idiots that somehow think that the market's going to bounce off some imaginary line or some sort of previous number. You're looking for them to be exit liquidity because you know that there is no support in a falling market, one that's falling very fast. So here's the first flaw. This flaw is in support levels that when markets falling sharply, that they're going to hold. That people are going to behave irrationally and that they're going to hold at this sort of number that you believe it's there. In reality, you're just exit liquidity for professional traders, which is why you get so hurt when you use these numbers. And by the way, if you say, "Oh, I don't use the support level itself, I put my order slightly below it," it doesn't matter. It will get found out. Okay. And please don't get angry when your support level gets crushed and your stop loss level gets triggered or whatever and blame the day or whatever. If you use levels that are easily seen, such as support levels, you are openly asking to be picked off in this way. Second strategy is selling put options. And the flaw is linked to this. So let's have a look at the selling put options and how it's sold to you out there. So let's say we have a stock at $10 and people will say to you, "Do you like this stock? Wouldn't you want to buy it at $9.50? And you might say, "Yeah, I quite like this stock. I wouldn't mind buying it at $9.50. So they tell you to sell put options, $9.50 strike put options. And here the argument is if the stock goes up, you get to keep the premium. If the stock goes down to $9.50, well, great. You wanted to buy it there anyway. Now you buy it there and because you've sold the put option, you keep some premium. And therefore your actual long level is not $9.50. It's below that. It's a win-win, right? And this is what entices people to do this. The flaw is exactly the same as with support levels. Exactly the same. The flaw is that you may be okay in a market that's just sort of grinding lower, but if this market falls sharply, then you're the schmuck who's buying at $9.50. If there's been some news event, some context change, or something happens, you're going to be left holding this stock. It's easy to say when a stock's trading at $10, I'd like to buy it at $9.50. The question is, what if it fell to $9.50 right now? The chances are you'd make a different decision. Again, the flaw is that you would be, the people in general, and you would be happy buying if it moved quickly. And this is how people that sell put options get hurt. They again become exit liquidity because they're the people that are forced to buy at 950 whilst this stock is on the way down, perhaps after some bad news. This is how people with short put options get blown up. And they do get blown up. This is a trading strategy that undoubtedly causes accounts to blow up from time to time. My rule number one is preservation of capital. You don't want to do anything that risks you blowing up. So support levels, selling put options, same embedded flaw is that they assume that on fast moving down equity markets that you'll just be comfortable buying and everybody else will be making rational decisions to buy. It's not the case. The result of that, you become the schmuck that becomes exit liquidity for bigger traders, professional traders, and for those trading the right way at that moment. You're effectively trading the market conditions as they were before we fell. And now we've fallen, the market conditions are completely different, but you're trading what was there before, that condition, that kind of psychology that the market was there before, that sentiment. They're both mistaken, and you need to avoid them both if you're going to make the step higher to become a better trader.